Hello, and welcome back to ATA's weekly live stream, or what I have taken to calling Death and Taxes, all things inevitable in life. This is put on by the ATA, hence ATA's live stream, which is the Australian Taxpayers Alliance. They allow us to be here and keep doing this. So if you like what you see, consider giving us a follow. And go along and maybe consider becoming a member if you feel like it, or at least check what we're up to, taxpayers.org.au. This is simulcast to X, YouTube, and Facebook. So if you're watching us, you're probably watching us through one of those platforms, although I may upload it to Substack and Rumble later. But if you're watching us on those platforms, please give us a like, give us a follow, give it a share, help it to flow around the algorithm so that more people can find us. That would be great. And also, please go and find us on those other platforms and give us a like, give us a follow. The details, if you're watching this here on Facebook or YouTube, the details down below this video will also give you the link to both Gene and my Twitter account. Gene, I finally remembered to do that. So please go there and give us a follow. I am one of your hosts, John Humphreys, Chief Economist at the ATA, and I'm joined, as nearly always, by Gene Tunny from Adept Economics. Gene, how you doing?
I'm good, thanks, John. How about you?
Another beautiful day in paradise up here. I'm doing well. I'm doing well. I'm
Excellent.
happy. It's been a very nice winter. It's not been very wintry at all, so quite pleasant.
Yeah, just speaking about what ATA's been up to, you've just published a new newsletter on Substack, Green's proposed gas ban. So we can chat about that later if you're up for it.
Yes, no, absolutely. Well, we could jump straight into that if you want. I mean, that mixes up the order a little bit, but since you've kicked off a segue, I may as well jump on it.
Absolutely. Tell me more.
This came from, so other states have already done this, by the way. So this is already happening around Australia, but it's not in New South Wales yet. So the New South Wales Greens, yesterday, they proposed to ban new gas connections in new developments, right? New residential and commercial developments. So that was the pitch. And as I looked at that, the same thing occurred to me that always occurs to me with these climate policies are done, that there is no hint of a benefit cost analysis. There's no hint that they will try and show that the policy creates benefits for the people of Australia. It's not that I disagree with their assumptions or I disagree with their arguments. There are no arguments. There are no assumptions. They just say, look, Victoria's doing it. It's got to be done. And that's about the end. And then, sort of morally browbeating you over the head, telling you you're a bad person if you don't want to do it. So I've said for a while now, and I'll keep repeating this, I think there should be a requirement, if not legal, then at least a moral requirement, that if you want to propose a new policy, you should be required to actually tell us what the benefits are, specify it. And so if it's a climate policy, the benefits presumably are that we don't have as much global warming. So I would ask, if you're putting forward a climate policy, give me the estimate for how much global warming you'll stop. Right? It's you use any assumptions you like. I'm not saying that's the end of the conversation. Yeah. That's the start of the conversation. Use any assumptions you like. Let us know the assumptions, and then we can start the conversation instead of just this hand waving. So the New South Wales Greens didn't do that. So I decided to do it for them. Being the magnanimous chap that I am, Gene, you know that. So I decided to pitch in and do their work for them. So I used the assumptions of the Climate Brigade about their policies. So they assume their policy will be wildly successful. So I assumed their policy would be wildly successful. And then I just plugged at the amount of greenhouse gas abatement they expected. I just plugged that straight into the IPCC estimates for how much that would cause warming by the year 2100. And the answer was, if we pursued the New South Wales Greens policy, global warming would decrease by 0.00004 degrees Celsius by the year 2100. So I had seen this put another way previously, and I quite like this way of putting it. I think it was Bjorn Lomborg who framed it like this. How much would a policy delay the warming by? So I calculated that as well using IPCC estimates. The New South Wales policy would slow down global warming by 10 hours by the year 2100. So instead of having 2.7 degrees warming by 2100, it would be the same amount of warming by the year 2100 plus 10 hours. So you can see there, once you're honest and transparent about the benefits, and these are their assumptions, right? This is not me with some sort of climate skeptic crusade. This is their assumptions. Once you're honest and transparent about the benefits, kind of the whole case falls apart. I mean,
Yeah.
Then you got the benefits. Then you have to put it against the costs, and the costs are higher gas prices for those left behind, higher house prices because you have to build these houses differently, higher infrastructure costs, which leads on to higher electricity prices and or higher taxes, less choice for consumers, and what's another one? Less reliable electricity grid. So these are the costs, and then you got to say, well, that could be worth it, right? A big enough benefit, it could be worth higher taxes, higher electricity costs, higher house prices, higher gas prices. That could be worth it. The benefit is 10 hours by the year 2100. Even if you're a climate alarmist and you think the sun gods are angry at us and there's going to be a climate apocalypse, this policy doesn't make sense. The people that we're hurting today matter, and it's for a 10-hour benefit in 76 years' time. So, and I think
John,
that's, by the way, why they don't make it explicit, right? I asked before, why don't they make it explicit? I suspect they know that if they were honest and transparent, people would see the case I just laid out, and they get a lot less political support. Sorry, Gene, you were going to say.
Oh, I was just going to say, I mean, what you're clearly showing is that this is such a marginal contribution to our greenhouse gas emissions, or certainly to global emissions, that they're focusing on the wrong things, really. This is a really small part of it. And it's going to come at a significant welfare benefit to people because, I mean, there's benefits. I mean, you're cooking with gas, aren't you? I mean, gas stove. I mean, that's a proverb, isn't it? Right? So, there are real benefits to cooking with gas. So this is going to annoy people in the restaurant industry, isn't it? Right? If they ban gas stoves, I think it's so it does come at a welfare cost. I mean, long term, I mean, I suppose we do need to move to electrify as much as we can. We do need to reduce. I mean, in my view, I think we do need to, over the long term, reduce greenhouse gas emissions.
Can I challenge you on that for a second, Gene? Can I challenge you that the sentence should be, we should reduce greenhouse gas emissions if the benefits of doing so exceed the costs?
Correct. Yes. Yep. I agree with you there. And also, and part of that is, what are we doing versus the rest of the world? If the rest of the world really isn't doing anything, then it doesn't make a lot of sense for us to lead. So, absolutely. Yeah, I agree with you. Go ahead. But I think fair points, John. I think that was a really great contribution.
Thanks. Well, the dirty little secret here is the issue isn't so much whether gas connections in New South Wales are a big percentage of Australia's emissions. The reality is, of course, Australia's emissions aren't a very big percentage of the world's emissions. So you're going to really struggle to get any Australian policy on its own that passes an honest benefit cost analysis, which is, of course, why we basically never see an honest benefit cost analysis. But I think the country would be better off with a bit more honesty and transparency in that debate. Anyway, so that gave me an opportunity to rant about that. So that email went out to anyone who's on the ATA, Australian Taxpayers Alliance, broader mailing list. You'll get those now in a new format. If you're used to getting our emails, they're going to look a little bit different, but it's still just us. You can also now find those articles, not just in email form, but you can see them later put up on Substack. So if you're curious, go along, check out Substack, Oz Taxpayers at Substack or .substack.com. One of the things I didn't mention at the beginning, which we normally mention, we are live. We are open to comments. If you're watching us on X, on Facebook, or on YouTube, feel free to send us in a comment, send us in a question, criticism, agreement, disagreement. If the situation arises, we'll try and put your comment up on the screen as we go. And if it's a question or a disagreement, we can engage. We can go back and forth. We are open to being distracted and sidetracked. So do your best. Call us wrong, call us names. It's all good. It's all part of the fun of live streaming. So, all right. With that out of the way and 10 minutes in, I haven't worked out a good name for this segment yet. So if you're listening at home, help us out. We've got the segment, Gene's Roundup. That's pretty good.
Gene's Grabs, something. Gene's Graphs.
Gene's Grabs. That sounds a bit dangerous. Get in trouble at work for some of that sort of behavior there, Gene. It's...
I never thought of it that way. Oh, John, you're the one with the dirty mind, mate.
But anyway, all right. So Gene's roundup, Gene's wrap up, the quick review of the interesting economic data or information that's gone on in recent history that you might not have seen. Gene makes sure that he sees the most important stuff for us and gives us the quick and dirty. So what have you got for us, Gene?
Well, today, John, I've got some slides on Rob Carlin. So Robert Carlin's excellent paper for the Centre for Independent Studies, where I'm an adjunct fellow, Leviathan on the Rampage. And I remember when this was sent around for review, basically I thought, wow, he's just knocked it out of the park with this paper. This is going to make big headlines, and it did. It got so much coverage. And essentially, Robert's showing that, I mean, we're up to around 39% of GDP in terms of government spending. Okay, so that's the Commonwealth plus the states, and like it's not quite as high as COVID, but outside because there was just ridiculous amounts of spending on JobKeeper and all sorts of other assistance, but it's a high relative to the whole post-war period, other than COVID. So it's a very high number, and so we're used to thinking about Australia having one of the smaller government sectors in the OECD among the advanced economies, around 30, maybe 35, 36, 37% of GDP. But now we're getting up to 39. So we're on this upward trajectory to a significant extent due to NDIS, but not just due to NDIS. And that's going to raise concerns about our economic dynamism. And our esteemed treasurer, Jim Chalmers, is running a roundtable in a couple of weeks on economic reform. One of the issues is economic dynamism. And I mean, my suggestion would be, this is what you got to be looking at: the fact that we're devoting so many of our resources to the care economy, to government services where there's very low productivity growth. So yes, I think Robert has raised a very important point. And another factoid, well, in the paper, it was Robert was really, I mean, it was a bit speculative what he was saying, but it ended up being, getting picked up because it was very catchy. What Robert was saying was that it looks like at the moment, if you look at the number of people who work in the public service, you look at the number of people who are getting pensions or other Centrelink benefits or earning their income from the NDIS, or they're in sectors where their income is to a significant extent dependent on government, such as education or health, you've got over half of the people in Australia earning their primary income from government. And this got a lot of coverage, and I think, look, that's a legitimate point to make. We should be talking about that. We should be talking about what that means for those of us who are paying for it, the taxpayers. And as in ATA, we should be very concerned about that. And we also should be concerned about what that means for productivity, what that means for economic dynamism. And I would suggest that this should be a central issue at the upcoming roundtable, and Robert should have been invited to that roundtable, and I don't see him on the agenda at the moment. So that's the first chart that I have. Any thoughts on that, John?
Well, firstly, I don't think we've received our invite yet either, Gene. I'm sure it's in the mail somewhere. It might have got lost on the way in to this roundtable. Look, another thing about that 50% number, you're right, it's quite speculative, so I don't think anyone's going to die in a ditch defending the exactitude of it. But one of the things to note, if you get to a situation where 50% of people rely on government for their income, you get to a position of like political economy where it becomes very difficult to ever change your trajectory, right? Because no one really has an incentive then to vote. You point out the ever growing size of government, and you always think, well, perhaps we could do something about it. Well, can you, if most people make their living relying on their ever-growing government? So that the political economy point is dangerous there. Just a couple of quick points about that graph. Where is it? I'll bring that back up.
Yeah.
So one thing to note about this, you've got that, was it starting at 35, going up to about 38, 39 with that spike around COVID. It is worth noting that these numbers historically, I'm pretty sure these ones they don't include government businesses. So the NFPC, correct, the non-financial public corporations. So if this is this is an appropriate measure of the size of government spending. But if you want to look at the total size of government involvement in the economy, it is a step above this again. So that's one thing to note. And the other one is, and I think I've said this to you offline or off air previously, measuring government as a percentage of GDP. I've got a little bit of a bugbear about that being the metric we use. Because if I may, if you'll indulge me,
yes,
you're stuck with me now. One of the main reasons, one of the main rationales for government spending, you scratch the surface and most of the government spending is justified for, we need to help people. We need to help people who can't afford their own health cover, can't help people who can't afford their own children's education. We need to help people if they fall on hard times, if they've retired without enough retirement money, if they have a disabled member in their family, et cetera, et cetera. You scratch the surface on most policies and it's, we need to help people because they don't have enough money, which is perfectly legitimate. It's a redistribution goal, basically, and that's perfectly understandable. I might question how much we do of it, but it's understandable. If you measure government size as a percentage of GDP, implicit in doing that is the idea that as we get richer, we need more government help for poor people, which I just think that sentence is a bit incoherent. Like, as we get richer, shouldn't we need less government support? Wouldn't that be the logical? I mean,
yes. I mean, assuming that the rising tide lifts all boats. But one point I'd make, or a little quibble, John. I mean, as you get richer, doesn't your ability to pay improve? So if you're in a society where everyone has low average incomes, taking the money off the average person to redistribute it, that's going to cost the average person a lot more than if people are wealthier. So I think richer societies are going to have a desire, or they've got a greater ability, a greater willingness to redistribute, haven't they?
I agree with both of those. They have a greater ability because they're richer, and a greater willingness because they're richer. But also, logically, there should be a lower need, a lesser need. I mean, if we're getting rich, it doesn't have to lift all boats. If it lifts any boat, then there should be less need for spending. But I'm not even saying there should be less spending. Implicit in measuring the size of government as a percentage of GDP is to assume if we all get 10% richer, we will need 10% more redistribution. That's implicit in the measure, which I don't think is logically coherent, right? I mean, it's not obviously true that we need 10% more redistribution to poor people if poor people got 10% richer. That's not axiomatically true, I would say. No, maybe there's a case for it sometimes, but it's not axiomatically true. So I think the correct measure of the size of government is real per capita. So the spending adjusted for inflation, adjusted for the population, and by that measure, Australia's government spending is just this really scary through the roof line. So,
well, we should put it up. We should do that chart. Just on the point about redistributing to the poor. I mean, I think we may be in a situation where we need to redistribute the redistribution, because so much of the redistribution is going to the middle class, isn't it? Right? It's just churn, or it's for childcare, or it's for family tax benefits, etc. There's a lot of redistribution that essentially just goes to people who probably don't need it, or many of them may be, I don't know. I mean, it's hard. You'd have to crunch the numbers, but I'd rather a situation where we have less of those transfers to the middle class and we reduce tax rates on the middle class. I think that we'd be better off with that. We'd have a more dynamic economy. So I'd just throw that out there, that we're in a situation where a lot of the redistribution is not actually going to the poor as you're describing. It's a different situation.
Yeah, well, that you're right. And I don't think that would be called redistribution. That's just the churn, right? The tax welfare churn, and we have a lot of that in the country. All right. Yes. So that's. But again, I mean, if we get 10% richer, do we really need 10% more churn? I would still say I challenge the assumption.
No, I don't
everything
think
the government does, you need to get more of it as we get richer. By the way, I think I found a graph. Let's see if I can bring that up in a second. I think I found my latest real per capita. There you go. Where is it?
Oh, you've got a chart.
And I don't know how to put it up. All right. I'll see if I can. Oh, there we go. That's the real per capita. I did this a little while ago, and I think at the end there it's a projection, but you can see the pretty consistent upward trajectory of the size of government since 1970.
So what is it, John? Federal revenue per person adjusted for inflation. What are the? I haven't got my glasses. So what numbers are we talking about in your chart there?
It goes from from 6,000 up to 18,000 roughly over the last roughly 50 years. So tripling, a
Wow.
tripling of,
Yeah.
and that's adjusted for inflation. That's adjusted for population, right? That's why I use per person. So to take the population element out, and I adjust for inflation, and from about 6,000 up to 18,000.
And
roughly
I mean,
speaking,
is it the case that we're getting 3 times superior level of government services as we would have been 50 years ago? I doubt it. I very much doubt it.
That is a good question to ask. Or is it the case that we have 3 times as much poverty, and the poor people are in 3 times as much need as they used to be? Or maybe we need 3 times more churn. I mean, that's a possibility. But yeah, anyway, I think it's a very interesting paper by Robert Carling, and very useful to get that back into the public mind. So that is a good one. And now what do I do with this? All right, there you go. What else do you have for us?
Okay, the other thing that got me interested was a recent paper by the folks at the Centre of Policy Studies. So these are the economic modelling gurus with the computable general equilibrium model. They were originally they were at Monash for a long time. Now they're at Victoria University. Peter Dixon set them up back in the 70s. Janine Dixon runs it now. This is a paper by James Gasecki and one of his colleagues, just showing the very high marginal excess burden. So the lost economic efficiency as you get another dollar of taxation revenue from stamp duty. So they looked at conveyancing or stamp duty on property, and worked out that the marginal deadweight loss is something in the order of 70 to 80 cents in the dollar versus I think it's about 24 cents for GST or income tax. And it's a really great economic modeling showing just how bad a tax stamp duty is and how we should be moving to more efficient forms of taxation. So I thought that was a good paper. Just more evidence or more modeling that favours looking at changes to the tax system, particularly getting rid of stamp duty, moving to a broad-based property tax, property value tax, land tax, for example. And I think this is one area where perhaps they'll have a big discussion on it at this economic reform roundtable. And hence I thought, really interesting modelling results from the people at COP. So good stuff from them.
Well, I was going to say it's probably getting predictable now that after everything is said anywhere on the show, I'm going to come in and say, however, actually. This stuff is interesting for the non-economists. This is measuring for every dollar that you raise in tax, how much does it shrink the size of the economy effectively? That's effectively what it's measuring here. And most people would prefer, as they raise tax, as they raise revenue, for it to hurt the economy as little as possible. So you want a low number here. You want to hurt the economy as little as possible when you raise tax. My one little quibble here is they've got income tax. And I look in there. I think they just use a labor elasticity. So I think they use a general equilibrium model, and those models are very big, and sometimes it doesn't really allow the degree of nuance on specific areas that you might want. And I don't begrudge them that. That's the best way to do what they were trying to do. But this can then hide some things that are important, and that is personal income tax. This will sound cruel. It sounds like I'm just trying to be mean to poor people. This is just what the data shows, and I'm not saying do anything about it. But income tax on poor people is very efficient, because basically the poor people can't escape, and they don't have an option of not working because they need the money, right? So this is the deadweight loss. The efficiency cost of income tax on poor people is quite low. The efficiency cost of the deadweight loss on income tax on higher income earners starts to get very high because they have much greater behavioral responses. Firstly, they can just change their labor supply response. Secondly, they got much greater capacity to hide their income. They got much better capacity to hire an accountant or a lawyer to be able to come up with schemes or funnel their money off or shovel their money through a business or a trust or put their money overseas. All of these options become available as your income goes up. And so you end up getting a much higher deadweight loss. And they're only putting one deadweight loss estimate in here. So they've got like an average number, but that hides a huge amount of diversity. Like my silly throwaway line, if you have one hand in a fire, one hand in the freezer, your average temperature might be nice, but your hands are not comfortable. So averages can hide a lot of important information. And this personal income tax deadweight loss average is, I fear, hiding some of that important information. But other than that, yes, it's important for people to put these stats out there.
Yeah, John, just on the all of the schemes to avoid tax as you get wealthier. I mean, what I find fascinating is how they're setting up holiday packages now. Well, the conferences, so they'll have there'll be an educational seminar at a ski resort, and the idea is that there'll be a session in the morning. You'll be learning, updates on new techniques or new findings in the literature. This is aimed at doctors or lawyers or people with plenty of money. And then you ski during the day, and then you come back and you have another, short class, so you can claim it all on. You can write it off all. Well, you can deduct it from your income as an expense. So
it's a tough life, isn't it?
It is a tough life. Yeah, but it's amazing how much economic activity ends up being driven by the tax system and the desire to avoid tax. I just find, that's just all fascinating. Righto.
You say that, so it just reminded me of one quirky line that I used to say. I used to lecture on the topic of behavioural responses to income tax at the University of Queensland way back when I was a young man. And one of the pithy throwaway lines that I quite enjoyed telling was, for ABBA was told that if they just are wearing clothes on stage, their clothes are not tax deductible. But if they wear costumes, then they are tax deductible. And that's what motivated them to wear such outlandish, wacky clothes, which became one of the themes they were known for, that had to be outlandish so that their outfits were tax deductible. So there you go. So behavioral change.
Brilliant. It's hard to imagine ABBA without those wacky outfits, is it? So that was a positive outcome of that. So yes,
indeed.
Very
Thank
good.
you, tax.
Okay.
You have one more for us?
I do have one more. It was the latest inflation data. So we had a good inflation result the other week. I think that was so much happens in the weeks now. It's hard to keep track of when things happen. I think this was last week, and we didn't get to it last session. But basically, we've had the headline CPI come in at 2.1% annually, so easily within the target band of 2 to 3%. But even more importantly is we've got the core inflation measures that the RBA really is concerned about. They've kept trending down. The important trimmed mean that the RBA focuses on has fallen to 2.7% through the year from 2.9. Almost, guaranteeing a rate cut next week. I mean, you'd never say that it's fully guaranteed because the RBA surprised us last month, but I think people are pretty confident this time. Yes, it looks like inflation seems to be under control. Touch wood. So yes, good result on inflation.
Famous last words.
Exactly.
Look, I've been saying for a while that I think the inflation genie was being solved. The RBA seemed to be holding their nerve against the political pressure to start cutting rates too early. Now, I think a lot of people have been tricked by the perception of economics into thinking that this inflation is what's caused the cost of living crisis. I think there's been a little bit of conflation about what's causing what here. I would argue that our cost of living crisis, when you feel poorer, like you can't buy as much, is caused by the fact that we've been in a per capita recession for most of the last 3 years. And we're getting poorer. Now, the way that's manifested to us is not being income cuts. It's manifested as higher prices. And what it's done is it meant your real income has gone down. But the reason you feel poorer is that your real income has gone down. So getting inflation under control, that's great. This is only going to fix the cost of living crisis if we can get our real wages growing. If real wages don't
Correct.
start growing, then yes, the inflation genie will be put back in the bottle, and that's a good thing in and of itself. But it's not necessarily going to ease the squeeze on people's cost of living unless we can fix productivity, right? So the problem's only been half fixed. Inflation fixed, productivity not fixed, and I would argue productivity is the bigger problem. But having said that, alhamdulillah, it's a good thing when we can get inflation back down under 3%. I think it'd be a better thing if we could get it under 2%, but let's take the wins when we can find them.
Exactly, John. So that's the end of Gene's graphs or Gene's grabs, however we want to describe this session, or segment.
If you're watching at home, come up with a title for that segment. I'll get you. The next episode will be free for you, which of course every episode is free anyway, but it'll be doubly free for you if you can come up with a good name for Gene's segment, Gene's Roundup. All right, so the topic that we promised people for this episode, I think it's been mentioned before, Labor's having their big talk fest. It was supposed to be a discussion of productivity. It's a productivity roundtable. Then it turned into kind of basically a tax roundtable, and now it seems to have turned into a tax increase roundtable in many ways. But anyway, maybe I'm being overly pessimistic. We'll see what happens. It's coming up soon. But one of the recommendations, quite an interesting one, coming out of the Productivity Commission, has been to change company tax in two ways. So pull me up here if I'm getting any of this wrong, Jane, but it's just to set the scene of what they're suggesting. Company tax is the statutory rate in Australia now is 30%. Now it's 25% if you've got turnover less than 50 million, but for most for many sizable companies, it's 30%. Now the idea is to cut it to 20% for companies up to turnover of 1 billion. Right, so that covers a lot more companies. That covers nearly every company except the big ones, right? And then you take it down more than just down to 25, all the way down to 20. So that's like quite a big company tax cut for the vast majority of companies in the country. But it's not all good news. The Productivity Commission constrained themselves by saying they had to not lose any revenue. So there's a trade-off here. They've also suggested a 5% new net cash flow company tax, or net cash flow tax on companies, on profits. So that's a new 5% tax, which is basically a different type of company tax. So what we've basically got now is, we've got 30% now. We're going to shift to having 20% for most people, 30% for the big business, but then an extra 5%. So really it's 25 and 35, right? Just looking through that veil. So there's two things going on. It's that shift to 25 and 35. But then the other thing going on here is this, and maybe we'll want to discuss this in a bit, a net cash flow company tax is different to the current company tax in an important way. And that's basically the main motivation from the Productivity Commission. If you flick through their report, is they think the cash flow method of doing company tax is a more efficient method, is going to encourage more investment. And interestingly, I'll throw to you in a second, but before we dive in too much, I agree. The ATA agrees. The ATA suggested shifting to a net cash flow tax, very similar to what the Productivity Commission suggested at the beginning of this year. It's one of our ideas in the lead up to the federal election. Now, of course, we were suggesting it associated with just a cut, right? So we weren't just shuffling; we were also cutting. But at least the concept, I think, is one worth considering, and it's one that I'm already on the record being sympathetic to. So, having put that context out there, Gene, unless I've got anything wrong about what's happening, can you tell us what you think of those changes? Are these changes worth considering, or are we mad?
I think they're certainly worth considering. I like the idea of a cash flow tax. I'd like it to replace the company income tax. I think
Absolutely.
one of the issues is, one of the concerns is they're introducing this at the same time as they're keeping the company income tax. So we're getting a new tax. And I think whenever governments introduce a new tax, there's a risk that the total tax burden is going to rise, right? I mean, we've got this great new revenue source, this new tax handle. Let's get more revenue out of it. So I think that's a bit of a concern. But look, I think there's pros for that cash flow tax, because by expensing your capital spending in the year in which it's incurred, that's effectively reducing it's increasing the return you can get from that. Is it for the return on investment? Because it's actually, you're going to get the more benefit from, in reducing your taxable income. If you think about the time value of money, because what's the alternative? You depreciate it over the coming years and you write it off over the coming years, where it's better for you if you can just write it off all now. And that means that you get it effectively, because of the tax treatment of it, you get that, you can undertake that capital spending at a lower price, can't you, at a lower cost? And so hence you're going to do more of it. And so I think that's a big benefit. It's potentially going to stimulate investment. I think that's a fair point. So there's a lot, and it also, there's a dynamic benefit in terms of, it's a real tax, isn't it? So what you're doing is you're exempting the interest earned and interest expenses that you have from the tax, aren't you? So you're ignoring those. And so what that means...
they're still deductible.
Sorry? Are we sure?
They're still deductible. I'm pretty sure. Otherwise, it kind of undermines a lot of the benefits of this. I know that there has been proposals for a cash flow tax that doesn't have interest being deductible. But
you wouldn't count the interest income. So I think idea. Yeah, so I thought you'd exclude both. But anyway, well, I don't think that's been fully set out in their proposal. We probably have to look at that a bit more closely, and they have to provide more modelling or more advice on that. But the way I've interpreted it is that there's this benefit because you expense your capital in the period in which it's incurred, so that your return on the capital investment can be higher, which means you're going to do more of it. And also there's this benefit from it removes that distortion or that bias in favor of debt finance of investment. Isn't that one of the arguments that there's a dynamic efficiency argument? I'm trying to remember exactly. But yes, there are definite benefits in favour of it.
Well, the other way of looking at this is basically a much bigger version of the accelerated depreciation scheme that has been rolled out every couple of years and then renewed. And the evidence on that is pretty good as well. I mean, it seems to just show that when you allow people to write off their capital expenses in the year they spend the money instead of having to depreciate over time, it does encourage a big spike in capital spending. And that makes sense for the reasons you said, right? It decreases the real long-term, present value cost of those investments, but it also really frees up the cash flow. I mean, that's not a big consideration for big companies, but for small companies, that can be a big consideration. So that's that. I think it's a good policy for those reasons, although I agree with you. Ideally, you just get rid of the company tax, switch to a net cash flow tax, and that's basically just a company tax with accelerated depreciation for everyone up to any amount. You could just word it that way as well, effectively. But one concern I have here is that it does, firstly, it does increase the top company tax to effectively 35%, which isn't ideal. But another problem, it pushes the problem further away, but the problem of having two different company tax rates. So currently we have that at the 50 million turnover mark, right? So you're on 25%, you hit 50 million turnover, now you're on 30%, which can create very odd situations because your tax rate doesn't go up as your profit goes up. It goes up as your turnover goes up. So you have some companies out there right now that are making very big profits, millions of dollars profit per year and paying the 25%, and other companies that are making a very small amount of profit and paying the 30%. Because they're at the 30% level, not because they've made more profit, but because they have more turnover and they might have a very low margin. So that's one concern I have there. But it also does create this incentive for companies to stop their turnover growing once they hit that magic number, because they may want to just keep below that currently $50 million threshold. Now this pushes it all the way out to $1 billion, but that's better. But the threshold's still there. I had suggested a while ago, I don't know if you've heard this one, Gene, but and maybe this is a bit cheeky, but the idea that you can have a two-tiered one, but if a company qualified for the lower tax rate, and then they went into the higher bracket through natural growth without any mergers or acquisitions, they can stay on the old system. So that's
right. Okay.
That's my suggestion there. Now, yes, of course, it would cost more revenue over time. But this basically would also be a disincentive against mergers and acquisitions unless they were really worth it. So it would be potentially a pro-competitive move. But it would allow companies, if they're at that cusp, if they're, $1 billion turnover -1, and they have a decision to make whether they sell $2 worth of material, that's going to put them into the higher bracket. No, they just went over that bracket through natural internal growth, not through some trickery or mergers or acquisitions. Let them stay under the old system. So there's a small suggestion.
Yeah, that's interesting. So, John, on the point about they're putting putting tax up on the 100 largest corporations, or however many it is. It's under 1,000 companies, isn't it? With the turnover over $1 billion.
I thought it was about 500.
500. That's right. Yeah, you're right. I think I was getting my numbers mixed up. So this goes back to this point Nicholas Gruen was making last week, and I think this is what's happening here. That there's a view within Treasury and probably within the Productivity Commission too, that there are all these companies out there that are earning super profits, economic rents, so to speak, because of the market concentration, oligopolies, supermarkets, or maybe they're in mining. And there's long been a view in Treasury that the mining companies aren't paying their fair share. They're not returning the correct amount to the taxpayer, and so this could be seen as a way of taxing those rents. And I wouldn't be surprised if that was behind some of the, if that's partly behind the PC's thinking there.
Well, they basically say it. So, what I read didn't say we're doing this because of that, but they wrote, these large companies that get caught up with the higher tax rate, they are often the same companies that are making super profits and are making, getting economic rents. Okay. So that was something that has been, directly referenced in the Productivity Commission's report on these proposals. So you might be onto something there. Maybe that was a motivating factor.
But is that the right way to do it then? So this is where I think we're better off if we sort of reform the whole thing. We have a cash flow tax, or we have the allowance for corporate equity tax, or whatever it's called. So there are various ways you could try to tax those rents explicitly, rather than this mechanism, which is could be seen as a bit of a sneaky way to tax them. Well,
the problem with this one, of course, is it doesn't target supernormal profits.
Yes,
it just targets big companies. So yeah, I agree with you. It's not the ideal way of targeting. I don't have a huge amount. I don't lose sleep over the businesses with over $1 billion turnover. They can be great efficiency in those businesses. They really can. There can be efficiencies of scale, which can provide a lot of jobs, provide a lot of benefits. But I am just naturally, and this is my politics coming through, I am naturally skeptical of the concentration of power. And there is a lot of concentration of power in businesses this large. And sometimes they use that power to lobby government. And so big business in bed with big government. And I am instinctively worried when such situations come about. And I'm very aware that the only real institutional factor that keeps powerful people in check is competitive pressure. I know you said before you also think democracy might do it, but I think competitive pressure is I'll put it this way, the foremost institutional mechanism for keeping powerful people in check. So I don't lose too much sleep over exactly what's happening to this big end of town, although I do want to get rid of that sort of step that I mentioned before, going over $1 billion. Yeah. In terms of taxing super profits, my preference would be actually to have a policy that more specifically targeted super profits. Yes. Rather than just targeting big companies and just pointing out, a lot of them make super profits. Yeah, sure. I'm sure they do, but a more specific targeting might be ideal. But you don't need everything in the world. And I'm not sure what else Labor's going to be considering. So while this Productivity Commission idea, I don't think is perfect, it's worth discussing. It's interesting. It's not crazy. It's not immediately in the bin, right? A lot of ideas go immediately in the bin. This one doesn't go immediately in the bin. So
fair point. So we know what they're going to be considering. They're going to be considering constraining negative gearing to only one investment property. I think that's likely. or restricting it significantly, and potentially cutting the discount on capital gains for the capital gains tax, and also reducing super tax concessions. I'll certainly be talking about those things because they're, this is what John Keogh was writing about in the AFR the other day. I mean, he's the one who said, well, it looks like, given who's on the agenda, I mean, the Grattan Institute, for example, they're very prominent on the agenda. It's essentially going to be a summit about increasing taxes rather than reforming the economy or productivity. I thought John nailed it there.
Yes, unfortunately, it does just look like a tax hike summit, which we do have a genuine productivity problem. And when Labor said they wanted to talk about productivity, I think we discussed it at the time. We both expressed skepticism that they would be realistic about a productivity agenda. But I said at the time, let's leave some hope. Let's not write it off before it happens. Let's see what happens.
Yeah.
Hope is free. It hasn't happened yet, but it is on track to disappoint, I got to say.
Well, but I want to see what they've got some real brain power there. I mean, people like Andrew Charlton and Andrew Lee and Daniel Molino, very impressive people, economists, PhDs from distinguished institutions. They've been looking at these competitive issues and looking at supermarkets. I want to see what they bring to the table. I mean, maybe there'll be some, interesting, genuine reforms there, but yeah, I haven't seen anything so far that's getting me super excited. But yeah, we should. Yep.
I thought this was worth noting in the executive summary for the Productivity Commission's report. They said something in there that I think is it's pretty simple. It's pretty obvious. I've said it a lot of times, so people are probably bored. But I think it's important to keep repeating it until some of it trickles into the back of politicians' ears. That a lot of productivity growth comes from having enough private investment. People who've studied sort of econ growth theory 101 think, oh, no, you get the investment, then you kind of hit, K star. And so you hit Y star and you have no more growth. And then you have to go and fund R&D at universities, right? That's the cliche thing you learn in third year economics. But the actual evidence for what drives growth, firstly, university R&D basically has no correlation. Government funding of R&D has basically no correlation. Private capital investment consistently correlated with innovation of total factor productivity growth. So I think that is an important thing. It seems like trite and old-fashioned, but it works a lot better than this new-fashioned stuff about constantly funding R&D and for people to take out their fourth master's degree in basket weaving or whatever else we're subsidizing these days. And the Productivity Commission explicitly said that, right? It said we need more private investment. Our company tax reforms are designed to encourage more private investment. So while I quibble about them putting the top rate up to 35%, at least they were motivated, I think, by proper economics, by good economics. And I think they were just constrained by the fact that they were trying to make their reform revenue neutral. So if you cut any tax in one place, they were going to have to raise it somewhere else. And inside the constraints they gave themselves, they probably came up with one of the best options they could. Although I would relax the constraint, just cut the revenue. The government has enough money. You mentioned it before with Robert Carling's report. The government is big enough. You're going to say?
We should be cutting spending and allowing room for tax cuts. What I'd say is, look, it's certainly a bold reform from the PC, one worth considering, one worth kicking around. What I'd ask you, John, is, given Albanese has said, look, we're not going to increase taxes. Basically, Albanese's trying to hose everything down because, he created all of this expectation. He and Jim Chalmers created the expectation, we're going to do all this great reform. And now they're trying to back away from it and say, look, don't get your hopes up or we won't really change things too much. What's the likelihood of the government adopting this PC proposal? Do you have any thoughts on that, John? How feasible is it? How likely it is that they'd adopt it?
Yeah, I mean, the Productivity Commission has historically been a lot more influential than most of the rest of us talking heads in the economic space. So you think once they put it out there and then it got a decent amount of coverage, I mean, it's not the other things you mentioned before that we should expect to see. The restricting capital gains tax discount and negative gearing, they both came directly out of an interview with the unions, the ABC interviewing the unions, which is a pretty good barometer of what Labor's going to do next.
Well, they're at the table, aren't they? I mean, they're at the table along with the Business Council and all of that. Yeah.
Well, the unions are part of the Labor Party, and the ABC, the only reason we don't say they're part of the Labor Party is because they've been co-opted by the Greens. But I mean, they're all running as bedfellows. So, but while what the union says, you could probably take it to the bank that it'll get a decent consideration. I think the Productivity Commission is one of those groups that would have to be given a decent consideration. It's got decent airtime, and maybe that means somebody has said, let's float this as a thought bubble and see if we get any pushback. I haven't seen too much pushback, so that indicates they might be.
Well, Judith doesn't like it. Judith Sloan wrote a very critical comment about it in the Australian the other day. She thought it was a bit of a mess of a proposal, and I think that comes out of the fact that they had to make it revenue neutral. Yeah. So you've got this hybrid, you've got this cash flow tax tacked on to the company income tax, and you've got these differential rates. So it is a bit clumsy in a way, and Judith really ripped into it. But I think it sounds like we're a bit more receptive to it than Judith. But
objectively, I think Judith's probably right. But within the constraints they gave themselves, which I mean, Judith would probably agree with us, just don't give yourself that constraint. But Productivity Commission works for the government. If the government says come up with a company tax reform that's revenue neutral, then this is probably the answer. A right-thinking economist would come up with, which I note the person who wrote the report is Alex Robson, who
very solid.
I've known for quite a while.
Friend of the show.
He's a solid economist. Sorry?
Yeah. Friend of the show.
We should actually. We should bring him on. Get him to defend this instead of us defending him. Maybe we get him and we get him and Judith Sloan in together and they fight. Oh.
Good idea. That'd rate well. Good idea, John.
So anyway, the last topic for today that I wanted to touch on, coming out of tax as well. And look, I'll segue this. I've tried to think of a segue. So company tax, the company pays the tax. A lot of people think, oh, well, that's great. The company's paying the tax. We don't have to. So it doesn't come out of my income. It's not GST. So I don't have to pay the company tax. And this is committing the fallacy of thinking who logistically pays the tax, they're the one that suffers the tax incidence. We say in economics, the tax incidence is who actually feels the impact of a tax. And the person who physically hands over the money to the government is not necessarily the same people who feel the impact of the tax. And we can see this in a number of ways. One of the most obvious ones is your income tax. So you feel like you pay it. Who actually hands the money over? There's very few people, if you're listening here, if you're an independent contractor, you do. But if you're a pay-as-you-go withholding, a normal wage slave in this country, you never actually get that money and pay the tax. You just don't get the money. The company you work for collects it on your behalf and sends it to the government. All right. So the person handing the money over is your employer. The person who feels the impact, quite obviously in that instance, is you. And the reason it's obvious in that instance is when you get your pay slip, it actually says what you would have been paid if this tax didn't exist, what you are paid because this tax does exist. And so it slaps you in the face and you see, the tax incidence falls on me, even though my employer was the one that handed over the money. And similar with GST. With GST, the business hands over the money to the government, but they nearly always tack that on to the price. So again, the tax incidence falls on the consumer paying more for their good, but the person logistically handing over the money is the business. And in both of those cases, we see it because it's legally mandated to make it transparent. It's required to tell you this is $10 plus GST. So it's $11. You see it and you go, aha, the incidence of this tax falls on me, even though I'm not physically paying it. And the same with income tax. This issue happens basically with all taxes. But with all other taxes besides those two, the system is not honest about it. And that's not necessarily because the system is lying. It's just not transparent, right? It's not mandated to tell you. So another one here that economists are well aware of, but some people get confused, compulsory super, paid by your employer. Oh, great, my employer's paying it. Well, yes, they're physically paying it, but the money is going to come out of lower wages for you, lower than what they otherwise would be. Not necessarily a pay cut, but a lack of a pay rise in the future. And so the incidence of compulsory super is felt by you, not your employer.
Yeah.
Company tax is another one.
Yeah.
Go ahead.
I was just going to say, John, historically, it was clearer because there was an explicit trade-off made in the 80s or early 90s, wasn't there, that there'd be the compulsory super in exchange for wage restraint, if I remember correctly.
That's right. The Accords before compulsory
Correct,
super,
yeah.
but during the Accords that Hawke brought in the AETs. Absolutely. So this is also true of company tax. People think, oh, the company pays it. Look, firstly, a company is just made up of people, right? So it's going to be a person that pays it eventually. But yes, a lot of people think, oh, if the company pays tax, that means it's the owners of the company that are paying it. Well, that is one option, but there's always three options, right? You increase the company tax. Can they pass it on to the consumers in higher prices? Sometimes they can. It depends how competitive the industry is. It depends how much competition they have from people who don't have to pay the tax. So if they're stuck as a price taker, they won't. But certainly there's plenty of businesses with some amount of market power. And if you tax that business, they can pass it on to their consumers. The other one is they can tax a company. It can show up as lower wages for the employees. Right. So you end up, it's basically the three groups. I mean, there's also the people they buy the products off and the people they rent their factory from. But the main three groups is you tax a company, you think they're going to be the one paying it. Well, the owners will pay some, the customers will pay some, the employees, the workers there will pay some, and it'll be a different mix depending on the elasticities of demand and supply in those specific industries. But it's very important to understand this because a lot of people fall into this trap of why don't we just tax that person instead of me, or tax this abstract concept, or make someone else pay for it. Who hands over the money is far less important than who ends up actually getting screwed over by the tax, right? And you need to follow that path all the way to the end to find out who is being stung. So another example of this that I think is commonly misunderstood, and I'm very much an outlier on this issue, but payroll tax. Payroll tax is, for all intents and purposes, just an income tax with a different name that they have called a different name because they had to, because the interpretation of the Constitution is we're not allowed to say it's an income tax. Right? But so legally speaking, according to the law, very different, totally different. That's a tax on the total amount you pay your workers, whereas income tax is a tax on the money earned by your workers. These are the same thing. I mean, yes, according to the law, they're different. According to economics, for all intents and purposes, payroll tax is an income tax. And then people say, oh, but the company pays it, your employer pays it for you. They do with your income tax too. I mean, that's the same, right? The main difference is when you handed your pay slip, you aren't told how much your employer paid in payroll tax because of you, but you are told how much your employer paid in PAYG, withholding, income tax because of you. So because one of them you're told about, the other one you're not, a lot of people live under this delusion that payroll tax is a totally different thing to income tax. And you end up getting these arguments about income tax is a good tax and payroll tax is a bad tax, or vice versa. All right, there are differences, but it's payroll tax is not mostly just paid by your employer. If you agree with the idea that income tax is mostly a tax that you are paying, then payroll tax is probably also a tax that you are paying in terms of lower incomes, right? You don't see it because it's not on your payslip, but that'll be the economic incidence of the payroll tax if you believe that's the economic incidence of the income tax. You have any thoughts on that one, Gene?
Look, John, I think you're making some good points about it's important to understand economic incidence. I think what would be better is if we come back to this next week with some evidence, with some of the empirical studies that break that down, that look at where the incidence falls. And the studies I've seen, there was a New South Wales Treasury study a while back on payroll tax, and I forget the proportions, but it does fall both on the employer and the employee. They find in their analysis. So I think it'd be good if we come back with some evidence of the different taxes. But I like where you're going with it. I just think it's something we need to dive into deeply with the empirics next week if we can. And
happy to do that. But by the way, I don't think you're wrong there, but I think it's probably true that income tax also partly falls on the business. We just don't see it because the slip we get, our payroll tells us all the incidence falls on you. And because that's the transparency, that's what everyone believes. But I think you'll find the incidence of income tax is also split between the employer and the employee. We just don't see it that way. So it'll be interesting to unpack the evidence, but it's also at a theoretical level. I'll be fascinated if you can think of what's the difference other than what we call it. Like if I change the name of income tax and I just called it the payroll tax system, and I changed the name of the payroll tax system and called it the income tax system, and I changed what they put on your payslip, would the incidence change? Because I'm not sure the incidence would change from changing its name.
Well, it depends on the design parameters. I mean, payroll taxes are often, it's on businesses that have a turnover above a certain threshold or a payroll above a certain threshold. I mean, it's progressive to an extent, but not, it is some of they're slightly progressive but it's progressive in terms of the total turnover. It's not based on the total wages bill. It's not based on your individual income. So
the way to frame a payroll tax is a payroll tax is an income tax that is a flat income tax, but you don't have to pay it if you work for a small business or a very small business. That's basically the version of it. I mean, that is then the same thing, right? So with people, your opinion on a payroll tax should be determined by this sentence. Would you prefer it if our income tax was lower and flatter and small businesses didn't have to pay it? If you think that those three things are good changes to make to the income tax system, you are describing the payroll tax system. And I know this will get me into trouble. This gets me into hot water because it seems like a very strange thing for someone like me to be saying. But tell me what else the difference is, because I think I've literally described the only differences between the two systems.
Yeah, but small business people instinctively hate payroll tax, or people who have to, pay the big payroll tax bill to the government, they instinctively hate it. Like it can be quite cruel, right? Depending on how they group the businesses together. So what you'll find is that people who own a few cafes, what ends up happening, they all get grouped together by the Office of State Revenue, and suddenly they have to pay this huge payroll tax bill that they weren't expecting, and they've suddenly got to hand over tens of thousands or hundreds of thousands, well, maybe not hundreds of thousands, but lots of money to the state government that they haven't budgeted for, and it causes them all sorts of trouble. So
the lack of budgeting is an issue there. So maybe if we just had the transparency, like the transparency we have about PAYG, the income tax that everyone's used to, makes it so that people kind of see it coming more. Maybe if we had that level of transparency, we could. Anyway, that's that. We don't need to go anywhere with that policy-wise, but I do think that is a really fun example of getting people to understand the difference between the logistics of paying tax and the incidence of paying tax. One last one on this, and then we've just hit an hour, so we'll wrap it up in a second.
Should we get to the comments eventually, John? But go ahead.
I'll just... Well, one last one. This came up from some work I was doing last week on workers' compensation payments. So employers often also have to pay for workers' compensation insurance on behalf of to ensure their workers in case their workers get injured or get injured at work. Or these days, it's in case their workers get sad at work. But put that aside, put the mockery aside. Now, this is another thing where all of the discussion going on in this debate, I put a submission into the New South Wales government on this, but everyone else was saying, they were speaking as if the employers pay it and the workers get the benefit, right? Because if the worker is injured, they've got insurance. So that's, this is effectively paying for insurance for the worker. But the employer is paying. And I just, I looked at this and followed it through a bit. The system is basically the same as compulsory super. The employer pays it, you get the benefit. A simple-minded approach to this thinks, oh, well, the employer pays it, I don't pay. The more logical thing is the tax incidence will fall on whichever factor of production has the most inelastic supply or demand, right? So, and that's probably labor, right? Labor's got a fairly inelastic supply. So there's a decent chance that as we keep trying to help workers by making their workers' compensation better and better, and therefore the premiums go up and up, that's going to end up showing up as relatively lower wages, exactly the same as higher compulsory super ends up showing up as lower wages. And I think this lack of awareness of the distinction between who pays and who really pays, right? Who pays logistically and who really gets screwed by a tax. That lack of awareness is really leading us down some unfortunate policy paths. And a bit more awareness about who is actually going to pay for this might get people to stop and think, well, wait a second, I just wanted, really great workers' comp insurance because I thought someone else was paying. If I have to pay myself, well, maybe I just want a normal amount instead of the gold-plated version. So understanding this could really help us get a little bit better at framing public policy, in my kind of sometimes humble opinion. So, but yes, all right, let's do that. There you go. What do you think? Instead of the rest of these taxes?
Well, I mean, it's not. I can't see how we can fund the modern welfare state with tariffs. I mean, I just can't see how we can do it. I think that's the issue Trump has too. Someone's having a bit of fun there.
Yes, look, it's.
I mean, I don't think we should. I mean, I think we certainly should be reducing the scale of the welfare state. I mean, but the idea that we could fund all government spending with tariffs in the modern world and with the size of government we have now, I just can't see it.
Yeah, I think we've discussed this before. There's some. Our viewer numbers just doubled in the last couple of minutes. That's interesting. I wonder where that came from. All right, look, I think there is. In the economic sphere, sometimes we're taught, we pick up our textbooks and it has this big section on trade economics and the economic inefficiencies of tariffs and tariff barriers. And look, and all of the theory as far as it goes is correct. But then there's a totally different section of the textbook that's on tax, and it talks in a very different way. But tariffs is just a tax. And the standard rule for all tax is if you introduce it at a low enough level, the efficiency costs are fairly low. And as you increase the rate, the efficiency cost goes up and up and up.
Yeah.
Right. And I think a lot of economists seem to approach economics as if, oh, income tax is fine. We need to, this is like this, the normie treasury economists or the normie government economists. And I think we have to have free trade. Tariffs should be zero because free trade is better for you and tariffs are bad for the economy. All true statements. And then they'll say, oh, but of course we need to have a decent sized income tax and company tax and GST and all these other taxes because we need to pay for all of this efficient stuff the government supposedly does. But that seems to be like a disconnect. It's like they put tariffs into a whole different category. It's just a tax on a type of activity. Now, it may be a worse tax than some other taxes, but it's just a tax. You put it too high and it can destroy your economy. And that's the thing I think a lot of the protectionists probably like, oh, that's Dan Ryan in China. That is Dan. All right. So Dan's going to disagree with me on this. We've had this conversation in the pub previously. But you put up the tariffs high enough, and I think you can destroy an economy. But a lot of economists act like if you put up tariffs a little bit, you're going to destroy an economy. And look, it might not be ideal. Let's put that aside. But there's a bit of Cassandra. There's a little bit of Chicken Little going on there. We have taxes anyway. If we rejigged it so that we cut company tax and cut income tax and had a slightly higher tariff, it's not the end of the world. Now, I'm not necessarily endorsing it either. We need to see the details of the proposal. But yes, I feel like there's only two categories here. There's the people who absolutely love tariffs and they just want to keep putting it up until they destroy the economy. And the other people that think tariffs is like a swear word. And if you touch it, you get AIDS or something. And I think there can be a happy medium where we treat it like all other taxes.
I'll have to dig this out, but I'm pretty sure I wrote something in the one of the Henry Review papers on this, on like when we had tariffs as the major revenue source for the Commonwealth, I don't know, 100 years ago. I mean, basically government spending to GDP was, I don't know, 10 or 15%, right? It was like much lower than it is now. So it'd just be so challenging to actually raise the amount of revenue you need without imposing tariffs that are going to be costly. Because as you mentioned, at low levels, low efficiency cost, but it goes up like this, right? Doesn't it? So if you double the rate of a tax, you quadruple the economic cost of the tax, the welfare cost of it.
Yeah, well-known result. Rule of thumb, you square the increase.
Yep.
Comment here on the workers' comp by Aussie. Yeah, New South Wales premiums up %. That was exactly what I was putting in the submission relating to. But for what it's worth, the Labor government in New South Wales is trying to wind back how much workers' comp covers, right? Because workers' comp has become so generous. It covers everyone. You stub a toe, you feel sad, someone yells at you, your dog dies, you go and get workers' comp. And if you can get a doctor to say that you're really, really sad, you can get that a lot of workers' comp for a very long time. I dramatize a little, but you get the idea.
I think right? a little, but go ahead. Go ahead. Okay. There's no doubt there are some people ripping it off. I'm not going to disagree with you there, but anyway, go ahead.
I mean, the amount of people claiming it for emotional distress has skyrocketed, right? So it's not just people cutting off fingers at work. That's what the original plan was. But the sector that's growing quickly and the costs are growing quickly is people who are saying something happened at work. I was bullied. I'm depressed. I can't go to work anymore. And I'm so depressed. I need to not work for years on end. It's like, maybe that's true for some people, but that seems very open to an expansive definition of what counts as. And anyway, putting that aside, for whatever the reason and however much you agree with it, what workers' comp covers has expanded significantly and well beyond the scope of what the original people who originally introduced the idea would have imagined. And so the New South Wales Labor government, to their credit, is trying to wind back what it covers. They're saying you have to have more emotional distress, right? It has to be your emotional distress is so bad, it is debilitating, and then you get paid. It can't be sort of semi-emotional distress. And so there's a big furor because, of course, the Greens and the left are very unhappy. And their basic argument is, don't worry, the business are paying. Business deserves to pay. We want all of the workers' comp in the world. So my submission, I said, Labor's kind of on the right track here. But I tell you what, if some groups really want this gold-plated extra level of workers' comp, why don't we say that the simple version is what you get by assumption, but you can salary sacrifice to get the gold-plated workers' comp, like workers' comp premium. Any worker can choose. They go to the employer and say, I will salary sacrifice X dollars of my income to get the extra workers' comp, the premium workers' comp. And then people could actually put their money where their mouth is. Now, would be able to see if people really want that premium workers' comp, people will pay for it themselves. Or we'll see whether everyone only wanted it because they thought other people were paying. And if that's the case, no one will buy it. And then we'll be able to see, wait a second, that wasn't worth it.
Interesting idea, John. And I would have to design it in a way you don't have that adverse selection problem. Because if I was inclined to actually want to make a psychosocial claim, I'd go, goody, I'll do some salary sacrificing in the short term, and then that'll set me up to lodge a psychosocial claim later on. I mean, maybe I'm overthinking this.
No, you're right. Yeah. That's true of all insurance, but you're right. So then that would put up premiums, and then people would have an incentive to signal and select to try and get around the problem of adverse selection. I mean, that's always an inevitable problem of an insurance market, unless you force everyone to take it. So, which is, I guess, the current system fixes it by forcing everyone to take it. But with the top-up one, it would be then open to adverse selection. It's already open to moral hazard, and no one's doing anything to try and address that. So this system might actually make it easier to address the moral hazard, but it would add adverse selection. So insurance companies are used to dealing with those.
Yeah.
Well, I think we've got to an hour 10. I didn't want to go back too far here or go too much longer, unless there was something here that was jumping out to you. But Canberra's already banned new gas connections out of suburbs now. Yeah, as has Victoria. So it's New South Wales wouldn't be Robinson Crusoe if they went down that path. This is from the beginning of this live stream. We were talking about the New South Wales government, or not the New South Wales government, to their credit. I think they're going to say no to this idea, but the New South Wales Greens wanting to ban new gas connections in new residential and commercial developments. And yes, some other states have done it.
Yeah. I mean, from what I've seen, I mean, New South Wales government seems reasonably sensible all around. So I think Mookie's very good. And Chris Minns seems to have his head screwed on reasonably well. So, yeah, they probably will reject that Reid's proposal. Yeah.
Well, I think they already have. So unless
good.
I've misunderstood the situation. No, I agree. I mean, I don't think it's hard to get too excited about too many governments in Australia, but once you're used to setting the bar lower and lower, then just standard, ordinary, everyday competence ends up looking wonderful. And the New South Wales Labor government is far less bad than what you might have feared. And given the New South Wales Liberals don't seem to be anything special, that's one of those states where even us, the dirty free market economists, might go, look, I can't see too much difference. There's pick the guy whose tie you like the best. Anyway, I think we'll just a second. I'll just put this up without reading it, and I'll just hope that Lyndon has a good comment. As a working director, as a contractor, workers' comp doesn't apply. Oh yes, well it's only over a certain limit in most states. Yes, well, that's the insurance system is going to factor in the risk of their paying out, right? That's the nature of insurance. Unless you're getting the government to cross-subsidize the insurance system, then insurance systems are going to have to factor in things as they become more risky. Unfortunately, that is the nature of life. Life is risky. Life is a sexually transmitted terminal illness. No one gets out alive, but we'll have fun in the meantime until it ends. Having said that, that's a nice way of wrapping it up. That's a good way of tying it back to that I've been calling this podcast Death and Taxes, the discussion of all things inevitable. We've talked a lot of taxes today, not that much death, which I think is probably going to be normal for us.
Well, we'll have to talk inheritance tax next week, John.
Well, that's death and taxes. That's right.
Exactly.
All right, that's
For
so.
a future
For those
episode.
listening at home, we've had suddenly a boom now. It's a tripling of people watching along in the last 20 minutes. So you missed all the early stuff. I guess there must be something about the time of 8 o'clock that or 8:30 that brings everyone out. I guess they all finished dinner or something. But thank you for joining us. And now that you've joined us, ladies and gentlemen, we're going to leave. But for those listening along, yeah, thank you for dropping in. Thank you for the comments. And Gene, thank you for joining me. We do these
John.
most Thursdays at 7:30, although based on the numbers today, perhaps it should be done at 8 o'clock. Well, Gene and I will have a chat and we'll decide what we're going to do about that. But yes, we do these every Thursday evening at a currently ambiguous time. So please come and join us on X, on Facebook, on YouTube. It's the ATA's channel on Facebook and on YouTube. Please go there. If you're not there now, please go there, give it a follow, give it a like, give it a share. And on X, this streams out through my personal account. You can find Gene and my X accounts on YouTube and Facebook by just looking in the write-up section. Come and give us a follow, give us some love. And I hope you will join us again next week. And hopefully we'll have a guest. And even if we don't, we'll have the wit and charm of Gene to keep me on track.
And you, John.
Thanks a lot, Gene.
Good on you, mate.
See you next time.
Thanks, mate. See ya. Thanks, everyone.